Welcome to Business with Louis, the show where we dive into the world of entrepreneurship and explore the concepts that can make or break a business. Today, we're going to talk about cash flow statement analysis, a crucial tool for any business owner or aspiring entrepreneur. So, let's get started. Cash flow statement analysis is essentially a way to understand the inflows and outflows of cash within your business. It's like keeping track of the money coming in and going out of your bank account, but on a much larger scale. By analyzing your cash flow statement, you can identify areas where you might be bleeding cash and make informed decisions about how to plug those holes. But why is cash flow statement analysis so important? Well, let me put it this way. Cash is king, especially in the business world. Without a steady stream of cash coming in, your business can quickly become insolvent, regardless of how profitable it may be on paper. In fact, according to a study by CB Insights, cash flow problems are one of the top reasons why startups fail. So, having a solid understanding of your cash flow is essential for making smart decisions about investments, funding, and growth strategies. At its heart, it involves analyzing three main components: operating activities, investing activities, and financing activities. Operating activities include things like sales, accounts receivable, and payroll. Investing activities involve purchases or sales of assets, like equipment or real estate. And financing activities include borrowing money or issuing stock. One influential thinker who's had a big impact on our understanding of cash flow is Peter Drucker, the renowned management consultant. He once said, "Cash flow is the lifeblood of business." And he's right. By focusing on cash flow, businesses can create a sustainable foundation for growth and success. So, let's look at some real-world examples of cash flow statement analysis in action. Take the story of Amazon, for instance. In its early days, Amazon was burning through cash at an alarming rate. But by analyzing its cash flow statement, Jeff Bezos and his team were able to identify areas where they could cut costs and improve efficiency. They implemented a range of strategies, including just-in-time inventory management and optimized supply chain logistics. As a result, Amazon was able to turn its cash flow around and become the e-commerce giant we know today. On the other hand, let's consider the example of Blockbuster, the video rental chain that went bankrupt in 2010. Despite having a strong brand and significant revenues, Blockbuster failed to adapt to changing market conditions and ignored the warning signs of declining cash flow. By the time they realized their mistake, it was too late, and the company was forced to file for bankruptcy. So, how can you apply cash flow statement analysis in your own business or career? First, make sure you have a clear and detailed picture of your cash inflows and outflows. This means regularly reviewing your financial statements, including your balance sheet, income statement, and most importantly, your cash flow statement. Identify areas where you can improve your cash position, such as by reducing unnecessary expenses, improving collection times from customers, or investing in assets that generate cash. One powerful tool for managing cash flow is cash flow forecasting. This involves predicting your future cash inflows and outflows based on historical data and business trends. By doing so, you can anticipate and prepare for potential cash shortfalls or surpluses, making informed decisions about investments, funding, and growth strategies. For instance, a company like Starbucks might use cash flow forecasting to predict its peak seasons and plan accordingly, ensuring that it has sufficient cash reserves to meet increased demand. In addition to these tools, there are several best practices that businesses can follow to improve their cash flow management. These include maintaining a cash reserve, managing accounts receivable and payable effectively, and investing in digital payment systems to reduce transaction costs. Companies like Square and PayPal have made it easier for small businesses to accept online payments and manage their cash flows more efficiently. Another key concept related to cash flow statement analysis is the idea of cash conversion cycles. This refers to the time it takes for a business to convert its inventory into cash. By optimizing your cash conversion cycle, you can free up more cash to invest in growth initiatives or pay off debts. For example, a company like Dell has optimized its supply chain to reduce its cash conversion cycle from 45 days to just 5 days. Finally, let's talk about some research findings that highlight the importance of cash flow statement analysis. According to a study by McKinsey, companies that prioritize cash flow management are more likely to achieve above-average growth rates and profitability. In fact, the study found that these companies tend to outperform their peers by as much as 20%. In conclusion, cash flow statement analysis is not just a dry financial concept. It's a powerful tool that can make the difference between success and failure in business. By understanding and applying its principles, you can navigate the complexities of cash flow management, identify areas for improvement, and create a sustainable foundation for growth and success. If you want to learn more about cash flow statement analysis or other business topics, be sure to check out our resources page. And if you have any questions or comments, please don't hesitate to reach out. That's all for today, folks. Don't forget to subscribe to our podcast and follow us on social media for more business insights and an analysis. And if you're ready to take your business to the next level, be sure to check out our upcoming courses and workshops. Like, share, and subscribe. And remember, every great business starts with action. Make your next move count.